The global semiconductor market has hit an absolute peak in 2026. Annual sales reached $975 billion, and almost all of that momentum is coming from one source: artificial intelligence. This chart shows exactly where the money is flowing. Generative AI chips now account for roughly half of the industry's total revenue, pulling in close to $500 billion this year alone. But look at the physical footprint on the other side of the graph. Out of the 1.05 trillion chips sold globally this year, those ultra-expensive AI accelerators make up less than 0.2% of the total volume. We are talking about maybe 20 million units driving half the global market. That imbalance creates a strict zero-sum game on the factory floor. When a foundry prioritizes manufacturing for these high-margin AI components, they are actively taking space away from the everyday silicon running personal computers, smartphones, and cars. Consumers are already feeling the squeeze. The capacity crunch has starved the market of standard consumer memory, driving prices up 4 times their normal rate this year. Analysts are projecting another 50% price spike by mid-year. Building the AI revolution is a massive physical undertaking, and it is currently breaking the bounds of the real-world economy. To understand why factories are so constrained, we have to look at the microscopic level. The computational demands of modern AI data centers have completely outpaced what traditional flat chip designs can handle. Instead of laying components side by side, manufacturers are physically stacking high-bandwidth memory and logic chips in 3D structures. By building vertically, the physical distance is drastically shortened, allowing data to move at multiple terabytes per second while drawing less power. Stacking silicon layers with microscopic precision requires highly specialized expertise and rigorous statistical process control. That specific engineering talent is incredibly scarce right now, creating a severe bottleneck at the assembly and test stages. By solving the speed and latency problem at the microscopic level, the industry created a highly complex, slow-moving traffic jam on the factory floor, directly starving the rest of the market of everyday consumer memory. Stepping up from the individual chip to the server rack, a second major bottleneck emerges. AI workloads require graphics processing units, or GPUs, to constantly talk to each other, generating massive amounts of what engineers call east-west data traffic. Traditional copper wiring simply cannot handle this volume of data. When you push that much information through copper at those speeds, the electrical resistance causes the cables to lose bandwidth, overheat, and eventually melt down. To bypass the copper limit, server architectures are migrating to co-packaged optics. This technology transmits data using paces of light through optical fiber, rather than sending electricity through metal. Transmitting with light slashes power consumption at the networking level by 30 to 50%, all while drastically increasing the total bandwidth available across the entire server rack. Yet, while light-based networks solve the immediate heat and speed limits inside the data center, the sheer number of servers being deployed passes the massive overall energy burden further up the chain, directly onto the macro power grid. At the macro infrastructure level, the scale of this build-out is colliding with reality. By 2027, AI data centers are projected to demand an additional 92 gigawatts of electrical power globally. Generating that much electricity requires heavy industrial equipment, and the supply chain is completely maxed out. Gas turbines are heavily backordered, and in many regions, the existing electrical grids lack the capacity to attach new mega facilities. The physical security of the entire AI supply chain is now tethered to a handful of global maritime choke points, specifically the Strait of Hormuz. The blockade of the strait in early 2026 did more than spike oil prices. It severed the supply of helium, a commodity where Gulf producers control a massive portion of global output. Helium is a non-negotiable requirement for semiconductor fabrication. It is the only gas capable of the extreme cooling and precision needed to process advanced silicon wafers at the foundry level. The digital cloud is tethered to physical geography, vulnerable commodities, and the security of a few specific shipping lanes. This physical fragility is now compounding a major financial risk. The semiconductor industry has structurally committed almost its entire capital expenditure to a single basket: AI hardware. If the companies buying these chips take longer than expected to monetize their AI models, the return on investment will stall. If the money slows down, data center projects will be delayed and chip orders will evaporate. There is also an innovation risk. As algorithms improve, future AI models will likely become radically more efficient. If they require significantly less compute power to train and run, the massive demand for physical hardware will shrink. This graph illustrates the risk of a market correction in 2027 or 2028. We are currently riding a steep, hyper-concentrated capital cycle. If demand normalizes, that curve will plateau and drop sharply, leaving factories with massive overcapacity. Because the industry has shifted so much focus away from standard silicon, traditional sectors like automotive manufacturing and personal computing may not be in a position to quickly absorb that sudden excess factory capacity. The artificial intelligence boom is pushing the boundaries of what our manufacturing and infrastructure can support. Ultimately, its success depends on whether the industry can build true system-level resilience against the physical, infrastructural, and economic limits of the real world.